these examples and understand really what is this AI in just a moment. But again, to go back to the overarching principle that you're sort of, arguing, is it really that the machine is going to become some sort of a magic bullet, and maybe, the guy who's got the best program or the best code, that guy or girl becomes the best fund manager? Then what happens to the whole breed of active human fund managers out there? Is this really a magic bullet, this machine or this magic program?
All I'm saying is it's not a magic bullet. I was discussing Anuj, it's like the vaccine, that if you take it, it doesn't mean you will not get the COVID. All it means is that your odds of not getting have improved. Okay, that's the point, that your hit rate, your win-loss ratios, your strike rates will improve versus a human-only approach. It doesn't mean that all machines will be equally good. For example, if you give a Ferrari car of equal capabilities to two drivers, one has never driven a Ferrari, he has driven only Maruti 800, the other is a pro driver. The pro driver with the Ferrari will win 100%. It's a given. You need a proficient human being to be able to build a great machine learning system. A bunch of engineers will make something. It will not work. We have seen through history, many pure quant people are not able to do a good job because for them, quant becomes only an abstract game. Life is ever changing. Life is flexible. For that, you need a decade, 2-3 decades of experience going into building those systems. So not all machine models are going to be equal, just as not all human beings are equal. You can put 10 fund managers through a CFA program. Not all of them will be equally good. One will be exceptional. 8 or 9 will be average. One will be terrible. More or less, the similar bell-shaped curve will come out even in quantitative investing.
Got that. Shankar, that's an interesting point you brought. And I dare say that, a professional driver perhaps will beat a novice if the professional driver is using a Maruti 800 as well. So, my question is artificial intelligence, it's fine, machine, it's fine. When it comes to equity investing, is it going to really become that big a change? Because, the human angle, equity market is also about greed and fear. Would machines, artificial intelligence be able to capture that human angle?
So, which is what, again, to give you a personal example, we call it the human plus machine model, okay? We should not think in terms of investing, okay? We should not think in extreme terms that only value investing is good, or only momentum investing is good, or only growth is good, only tech is good, only, FMCGs with brands are good. In investing, you need to be relevant. You need to be present wherever the market wants you to be present. So you're absolutely right. When a very, very cataclysmic event, let's say COVID March 2020 happens, a machine will never be able to react that fast. But I'll tell you what the machine can do. In February, the machine can tell you that, look, there is a lot of chatter around this because the machine will go and scrape data from across the social media universe and elsewhere and tell you that, look, this is becoming a very serious, in a way, think of it as a Google Trends. Okay, in a very simplified form. It will tell you that this thing, which is not visible to human eyes, becoming a very rapidly growing trend. So Google Trends is the most simplified version of that. If you expand that on a larger basis, you will be alerted to a problem. That is most of the battle won. If in February 2020, I know a big problem is building up which people are unaware of, I can take protective action. That the machine tells. You see what I'm saying?
Yeah, I take your point. So, Shankar, that data itself is no longer the edge. The capacity to process it properly, that's the edge today, really. On that note, let's take a very quick break. This conversation is going to continue. Don't go anywhere. Back with Shankar Sharma in just a bit.
Welcome back. You're watching CNBC TV 18 Investment Guide, and this week we are discussing an interesting topic, which is machines and artificial intelligence and their impact on the markets. Our guest today is, of course, Shankar Sharma. So, Shankar, if you're saying that, this is what's going to happen, the machines taking over data analysis, what happens to alpha then? Because then it becomes commoditized, right? Everyone has the same machine. Then should we expect lower alpha?
Everybody will not have the same machine. They might have the same PC. But what goes into the PC is not going to be the same. Like I said, 10 fund managers, the same CFA program, One will be a genius, 9 will be average, or 8 will be average, will be a dud. It will be exactly the same thing in the machine. There will be no difference in the distribution of returns. There will be some very, very exceptional quantitative fund manager. For example, Renaissance Technology. We all have heard of that, Jim Simons. He's one of the most phenomenal quant fund managers, and I know of several others as well. But on the other hand, you had a long-term capital also, LTCM, which blew up in 97, 98. That was also a quant fund. So remember, this is also going to follow the same trajectory in terms of return distribution as human beings. It will be ultimately driven by who are the most skillful set of humans coding the machine in the most skillful manner. How much depth are you going to go into? I mean, I mentioned only two of the things we look at. We look at, I think, 950 such things. Tomorrow we might be looking at 1950, but somebody using only 5 factors and maybe making a quant model, they will not be able to produce those kinds of results. So it will follow the same bell-shaped curve distribution as human beings will. But in general, Anuj, as investors, you're better off with somebody who has that edge than with somebody who does not, because of the simple fact that machines will not have the emotions, which is also a plus. You can call it a negative. It can't judge emotions as well as human beings. At the same time, it will not fall prey to those same emotions as human beings do. So we will end up justifying our wrong actions. SBI was great at 420. It is 300, excellent buy. A machine won't go down that path. And we were just discussing SBI and a couple of other banks just before the show. Those things the machine will not do, which itself is 90% of the battle won. Because human beings are never consistent. The machine is always consistent. If you are consistent in investing, you will eventually win this game. It is all down to that one simple thing, being consistent, being a slave to your processes. And as human beings, we end up changing our process. Market bahut chal gaya, change kar do, डूब गया, change kar do. That's what the machine will not do.
Okay. So, Shankar, also educate us as to where AI and machine learning, where is it making its presence felt already in the investing world? I mean, I don't know, the bigger banks, they're the ones with the biggest bucks. I don't know if they've started doing it or not. Who are the major quant sort of players out there? I know you folks at First Global, you're applying a lot of these theories and practices in your approach. And is there any evidence that this is actually generating better returns than traditional investing?
Oh yeah, there's tons of evidence. So a lot of the quant funds are not great storytellers. That's the difference. So Warren Buffett, who's old economy style, is a great storyteller, vision of a Coke or vision of a Gillette and all that. In quantitative, it becomes a very, very clinical game. So it's not a very publicly understood or easy to sway people with those stories. But I can tell you, I mean, I was talking to a fund manager in Berkeley the other day. He was telling me that he had given his money to a gentleman called Peter Muller. You may not have heard of him, but he used to run something called a PDT fund, an instant Morgan Stanley. Then he spun it off. He said he gave his money to him in 2009 or something. He said, Peter delivered me 18% CAGR on my money with only a 3% volatility for 12 years. And last year, he returned my money to me saying that I don't want outside capital because now I have my own $5-10 billion coming out of, again, fund management. And that's the kind of number, 18% CAGR with a 3% volatility. Which human being in the world can deliver those numbers? Not even Warren Buffett or his grandfather can deliver those numbers. So there is a vast body of people, except they're not very public. The point is, we at SG are completely quant, and 90% of our decisions, 90% of fund management is 10% is human. I think the difference becomes also that if you are a fund management company, you have an army of people there already. What do you do with them? You have highly paid CIOs drawing $1 million, $5 million salaries. You have battery of fund managers, battery of analysts. All of that can be done by far fewer people. So how on earth do you disrupt your own self? That is going to be a challenge for all these mutual funds. I see that as a genuine problem.
Okay, so Shankar, in terms of the landscape for the Indian, broking firms or portfolio management companies, what kinds of changes do you see? Do you see, quant comprehensively beating traditional investment? And if yes, will these companies have to adapt themselves accordingly?
I don't think It's going to be a very linear path. Uh, just as globally, quant occupies a space, so do human fund managers. But the data, or just like, if you say ETFs and active, there are enough ETFs. At the same time, there are many active managers out there. Not as active has gone completely extinct. So the landscape will change, but it's not as if you're going to get 100% replacement of human beings by machines or vice versa. I think the pie chart for quant will increase. The pace at which it increases depends on the quality of people coding. I'm back to the same point that it requires great investment, skill to begin with to code a skillful machine. So I don't know whether the old guys will be able to adapt. Even if they do, the difference is that how much do you believe in that? Because if you don't believe in it, you will put a little bit of resource in it. Then you will put couple of quant funds in your overall portfolio of 100 funds. That is not going to cut it. Either you believed in it and you've done it. It's like Vanguard. They don't do active. They have done ETF because they said this is the future. But if you want to do a mixed bag, you're neither here nor there. So it'll be an interesting time. All I can say is there's going to be a very interesting landscape for investment management companies in India to see whether people change or they continue with what they're doing, and we'll see what the outcomes are.
Shankar, then I'd like to end by overlaying a lot of what we've heard today, what we've learned today on today's context. When markets are in the midst of unprecedented disruption, something like a once in 100 years pandemic, or a depression that few would have seen, or a crash of the housing market, what we saw in 2007, when these unprecedented events come through where there are way too many unknowns, we didn't know that the second wave will be so chronic here in India, right? Up till about a month back. Then does AI and machine learning, does it still have as big a role, or is that a point in time where perhaps human nuance starts becoming as important, if not more, in those exceptional circumstances in the market?
Yeah, which is exactly what I said, that in March 2020, we could sidestep the crash of March 2020 because in February 2020, we were alerted to a problem, but we had to make the decision that COVID is going to become big as human beings. Same thing even now in the second wave. The data will tell you that there is a problem. Now, what you want to do with that is going to be human decision, which is what I said, that a combinatorial approach is the approach of the future. It is neither one extreme of human only or the extreme of machine only. Smart human beings with smarter machines are going to eventually beat either of these two extremes.